hits $1.3 million in '89.
$1 million house.
And then, bam, crashes 60% down to $425,000 just 3 years later. Wipe people out.
And the dot-com bubble. It's more recent memory for many.
Fueled by easy money, Y2K liquidity fears, NASDAQ went vertical, then burst. Companies like Enron, WorldCom, dot bombs, ruined retirements, shattered confidence, again, chasing price without looking at real value.
You also mentioned something called an invisible crash. What was that?
Yeah, this is fascinating. From 1966 to 1982, for 16 years, the Dow Jones average basically went sideways or down if you adjusted for inflation.
So even if the number looked okay, your purchasing power was shrinking.
Exactly. Using a more realistic measure of inflation, not just the official CPI, investors were losing ground silently. It was an artifact of the fiat system, the constant credit creation, eroding value in ways that just couldn't happen under a gold standard. You felt like you were treading water, but the current was actually pulling you backward.
Which underlines your point. You can't measure value reliably using a depreciating measuring stick like the fiat dollar.
You really can't. It distorts everything. You have to compare assets against other assets, stocks versus bonds, real estate versus gold, etc., to get a true sense of relative value.
And this ties into the criticism of the official inflation measure, the CPI, the CP lie, as some call it.
Right. Critics argue the Bureau of Labor Statistics uses methods that deliberately understate inflation.
Like what?
Things like deletion. They create core CPI by just removing volatile food and energy prices, which is, stuff people actually buy. Substitution. If steak gets too expensive, they assume you switch to hamburger, so they adjust the basket downwards. Or replacing the cost of owning a home with a theoretical owner's equivalent rent.
Which might not reflect actual homeownership costs at all.
Often doesn't. And hedonic adjustments, trying to account for quality improvements. Your new phone costs more, but it's better, so they adjust the price increase downwards.
So the result is an official inflation rate that feels much lower than what people actually experience.
That's the argument, that the official CPI significantly diverges from a real cost of living increase, making inflation look artificially low.
Okay, so we have a potentially unreliable measure of inflation, a history of bubbles. What are the big storm clouds gathering now, according to the source material?
Well, first, just the sheer mountain of debt. Back in 2008, the U.S. national debt was around $9 trillion. The source, updated in 2015, cited a fiscal gap, including unfunded liabilities of potentially $210 trillion.
$210 trillion. That number is staggering. What does that include?
That includes things like Social Security, Medicare, basically promises the government has made for the future, but hasn't actually set aside the money to pay for.
Unfunded liabilities.
Exactly. David Walker, who was the U.S. Comptroller General, but basically the nation's top accountant, he resigned in 2008, calling this fiscal imbalance the greatest threat to the U.S. Congressman Ron Paul has been warning about it for decades, too. These are huge future obligations.
Then there are trade imbalances.
Yeah, the U.S. running persistent trade deficits, importing more than exporting. How is that financed? Largely by foreign central banks, especially in Asia, buying U.S. Treasury debt.
How do they buy it?
Often by creating their own currency, yuan, yen to buy the dollars needed to purchase U.S. bonds. This expands their money supply, potentially causing inflation there, which can then get exported globally as the prices of their goods rise. Japan's done massive money bombs, too, trying to keep their exports cheap.
It's all interconnected.
Deeply. And then there's the derivatives monster.
Warren Buffett's financial weapons of mass destruction.
That's the quote. These are incredibly complex financial contracts based on underlying assets. Think credit default swaps during the 2008 crisis.
Right, insurance on mortgages that went bad.
Exactly. The problem is the sheer volume, the leverage involved, and how interconnected everything is. LTCM collapsing in '98 almost took down the system. Then, 2008, countrywide, Northern Rock and the UK, Bear Stearns, needed massive bailouts just to stop a complete meltdown. The system came terrifyingly close to freezing solid.
It really underscores how much the system relies on faith, doesn't it?
Absolutely. It's a confidence game in many ways. And the source argues it's structured, perhaps unintentionally or perhaps not, to transfer wealth from those who don't understand it to those who do. Like Ron Paul says, easy credit and fiat currency often function as a tax on the poor and middle class.
So Mike Maloney, the author, laid out a kind of sequenced prediction, a roller coaster crash.
Yeah, he proposed a likely path based on historical patterns. First, a threat of deflation, like we saw glimpses of in 2008.
Okay.
Second, massive central bank response, helicopter drops of money, bailouts, quantitative easing. We definitely saw that.
Sure.
Third, big inflation, not necessarily consumer prices right away, but asset prices soaring, stocks, real estate.
Yep, seen that too. What's next in his framework?
He predicted a period of real deflation, a serious contraction, maybe a crash in those inflated assets, pulling currency out of the system, followed ultimately by the final stage, hyperinflation, as governments potentially lose control and print money without limit to cover obligations.
And as of 2015, he felt the first three stages had played out.
Largely, yes. And the central bank actions, while maybe necessary in the short term, had magnified the underlying imbalances, potentially making the later stages even more severe. He saw real deflation as the likely next major phase, then hyperinflation, with scary possibilities like civil unrest or food shortages as tail risks. It's a sobering outlook.
Definitely sobering. But the flip side of crisis is opportunity, right?
Right. That's the crucial point. Wealth isn't usually destroyed in these shifts, it's transferred. From those unprepared or unaware to those who understand the cycles and position themselves accordingly. That transfer creates potentially huge opportunities.
And the core belief here is that gold and silver benefit.
The fundamental argument is there's basically no plausible scenario where gold and silver don't significantly rise in purchasing power over the long term. They always eventually account for all the excess fiat currency created.
And the scale of creation this time is unprecedented.
Absolutely gargantuan compared to past cycles, off the charts.
So gold, even after its runs, it still has room to grow.
According to the analysis, yes. Its inflation-adjusted peak from 1980 would be well over $2,200 today, and it hasn't consistently stayed there. Some calculations suggest gold could reach figures like $15,000 or even $18,000 an ounce just to balance out the monetary base and credit expansion. Those are just models, of course, but they show the potential scale.
And silver. You mentioned it was even more undervalued.
Dramatically so, based on historical ratios and supply dynamics. Government stockpiles have basically vanished. The U.S. went from billions of ounces to maybe 20 million. Industry uses a ton of it. It's historically cheap relative to gold. The saying was, gold's cheap as dirt, but silver's cheaper than dirt. Huge potential leverage.
This connects back to cycles, right? Like the Dow-gold ratio.
Exactly. Markets move in cycles, stocks get expensive relative to commodities, then cheap, then expensive again. The Dow-gold ratio tracks how many ounces of gold it takes to buy the Dow Jones Industrial Average.
And it swings wildly.
Hugely. In 1929, peak stock bubble, it took 18 ounces of gold to buy the Dow. 3 years later, depression bottom, it took only 2 ounces.
Wow. So if you switched from stocks to gold in 29, then back to stocks in 32.
You could have multiplied your share ownership by 9 times. That Paul and Pam story illustrates that making strategic shifts between asset classes at the extremes of these cycles is how real generational wealth can be built. Pam's grandfather's initial sum dollars, managed through cycles, potentially became $11 million in gold by 2008. The same $30 left in stocks. Maybe $12,000. Big difference.
Where is that ratio now, roughly?
Well, recently it's been hovering around, say, 14 or 15, but the prediction is that these cycles tend to overshoot. It could potentially fall way below 1, maybe even to 0.5.
Meaning 1 ounce of gold could buy the entire Dow twice over.
Theoretically, yes, or at least get much, much closer to parity. Meaning gold could potentially buy maybe 28 times more stocks than it can today if that historical pattern repeats and overshoots.
And even if the cycle feels long in the tooth time-wise?
Right. We might be, say, 75% through the time of this major cycle shift away from paper assets towards real assets. But the biggest value gains, maybe 75–90% of the move in precious metals, could still be ahead. The most dramatic part often happens towards the end.
Let's connect silver to real estate. That example was powerful.
Yeah, in 1980, at silver's peak price, it took about 814 ounces to buy the median U.S. single-family home.
Okay.
The projection, based on historical extremes and potential currency revaluation, is that in the next cycle, peak for silver, it might only take around 500 ounces.
500 ounces. What's that in today's dollars?
Well, silver's volatile, but let's say around $18 an ounce, hypothetically. Yeah. That's only $9,000. The idea is that $9,000 worth of silver could potentially buy a median home outright someday, or put 20% down on 5 homes. It's about a radical repricing of assets relative to each other.
That's a mind-blowing possibility. Okay, so if people are convinced or at least intrigued, what are the practical steps? First step.
Become a critical thinker. Do your own homework. Don't just take Wall Street narratives or mainstream news sound bites as gospel. Understand why things might be happening.
And be aware of the pitfalls when getting into metals.
Definitely. Big one. Avoid leverage. Margin accounts, futures, options. These are tools for professionals, mostly.
Why? They promise bigger returns.
They magnify winnings, yes, but they magnify losses even more. That double-edged sword analogy, it's like a butter knife on the way up, but a surgical laser on the way down. You can get wiped out very, very quickly. Not recommended for most investors buying physical metal for wealth preservation.
Okay, no leverage. What about numismatic collectible coins?
Be very careful there. Dealer mock-ups, the premiums over the actual metal content can be huge. 15%, 50%, even 100% profit for the dealer versus maybe 1-5% for standard bullion coins or bars.
So you're paying a lot for the rarity or condition.
Right. And while grading services exist, the value depends heavily on collector demand, finding that specific buyer later. It's a different market than just buying the metal itself. And definitely steer clear of brand new limited edition collectibles pitched as investments. Stick to bullion for the core position.
What about dealers advertising heavily on TV or in magazines?
Generally a red flag. Think about the cost of that advertising. It's enormous. To cover those costs, the dealer has to charge significantly higher prices than dealers who rely on word of mouth or online presence. Fair margins just don't support massive ad campaigns. Plus, prices change too fast for print ads anyway.
Good point. And the reporting requirements. People worry about the government knowing they bought gold.
There's a lot of misinformation, sometimes used as a scare tactic. The reality is, in the U.S., neither the dealer nor the customer has to report typical precious metals purchases of any quantity.
No reporting.
The only exception is under anti-money laundering laws. If you make a cash transaction over $10,000, the seller, the dealer, has to file a Form 8300 with the IRS. But that's for large cash payments only. Paying by check or wire transfer doesn't trigger that reporting for the purchase itself. Selling metals later might involve a 1099-B, depending on the product and dealer, but buying is generally private.
Okay, that clarifies things. So, looking at Maloney's own approach for context,
Yeah.
how did he allocate?
His personal strategy, as shared in the source, was heavily weighted towards metals, about 80% of his investment funds. And within that, 50-70% was in physical form, with a strong bias towards silver over gold due to its undervaluation. Again, that's just his example, not advice for everyone.
But the emphasis is on physical.
Absolutely. Physical precious metals held directly are seen as the safest, simplest way. Minimal counterparty risk. Buy it, store it securely, hold it until the cycle turns and it becomes clearly overvalued. Then consider selling or trading for other undervalued assets.
Why just buy mining stocks? They're related to gold and silver.
Right? They are related, but they are not a substitute for owning the physical metal. Mining stocks are shares in a company.
Subject to management, costs, politics.
Exactly. Operational risks, political risks in the countries they operate in, exploration success or failure, debt levels, management skill. All sorts of things affect the stock price that have nothing to do with the metal price itself. Gold can go up, and a specific mining stock can go down if they have problems. They offer leverage, potentially, but also much higher risk than the metal.
Okay, so focusing on physical, how do you choose a dealer?
Do your due diligence. Check with the Better Business Bureau, bbb.org. Look for members of industry groups like the Industry Council for Tangible Assets, ictaonline.org. Get clear quotes that include all costs, shipping, handling, and full insurance until it's in your hands. Compare prices.
And what kind of physical metal to buy? Bars, coins?
Depends on your goals. Form follows function. Are you focused purely on lowest cost per ounce, usually larger bars? Or do you want smaller units for potential barter or easier selling, like 1-ounce coins? Or portability?
What are common options?
Large bars for lowest premium, old U.S. silver coins, pre-1965 dimes, quarters, halves, contain 90% silver and are easily recognizable. Modern bullion coins like Canadian maple leafs or American eagles are very popular and liquid.
You mentioned gold without borders jewelry.
Yeah, that's typically 22 karat, so it's durable but still high gold content. Jewelry sold close to its melt value, not with huge artistic markups. It can be a way to hold portable wealth that might be treated differently than bullion when crossing borders. And in the U.S., selling personal jewelry doesn't usually trigger a 1099-B form like selling bullion might.
Interesting. And pre-1933 U.S. gold coins.
Those are interesting because they're historical coins, often available at relatively low premiums over their gold content right now, but they have potential numismatic upside. They could appreciate much faster than bullion if collector demand surges. Sort of a hybrid play.
Okay, you bought your metal. Now, where do you put it? Safe deposit box at the bank.
That's a common choice, but understand the limitations. They are technically safe deposit, not safety deposit. The bank doesn't insure the contents against loss or theft, Banks can fail or close branches. Boxes can